Welcome back to another Market Radar podcast. Thanks for tuning in. Let's take a look at what the NASDAQ did this week. Pretty much straight plummeting. We're back down below Momo once again. As we said, the other indexes, ES, RTY, and YM have all been bearish trend now. And so we did warn that there is going to be this downward pressure on the NASDAQ, and we're seeing that play through now, especially now after we saw ES bounce off of Momo, failing to break there. That was a sign that this move upward is not going to continue, and now we're seeing that. So we're looking to see the NASDAQ also flip bearish trend. That seems to be the next card on the table. Let's take a look at what bonds did this past week. Straight carnage in the bond market as well. We've been warning about this. It's don't try to catch the falling knife. We are staying far away from this. We don't know when this is going to bottom. That's not what we do. We don't call tops. We don't call bottoms. We ride the waves. And right now, this is a strong wave down, and this is not the kind of knife you want to be catching. There was a small little bounce a few weeks ago. Some brave souls went long there, but if you are planning to go long bonds and really risk trying to catch this falling knife, you gotta have a tight stop, because this could very well keep going. We don't know when this is going to bottom. We're not gonna try to know. We might know after the fact what causes bonds to bottom, but at the end of the day, we're sticking to our rules. Everyone in the Discord is following along. They know our rules. They know what we're doing. They know our plan, and we're going to stick to it. It's what's worked ever since our models backtesting back to 2004. That's what we do, and so we're going to follow along with it, and we're not trying to catch this bottom here.
You can always try and chase a bottom, but the problem with doing that in this type of situation is you don't really know, and it's really just a guess, right? You don't have any. The problem when you chase bottoms is you end up using the low as the stop most of it, right? Like, for example, if you bought here and it does bounce, your low is the stop. And you really don't have a profit target, right? Because you're looking for the bond trade. So unless you're trying to scalp something within a bearish trend, do as you please. But you end up getting stopped out most of the time at break even, right? If you bought here, goes up, reverses, you're just doing break even trades, and you're just hoping that one day you're going to put a trade on that's going to send it to the heavens, and you're going to just be long the bottom. And there's no point in you doing that, because all that you end up doing is frustrating yourself and pretty much putting yourself in downside, put yourself in front of downside risk for no reason. So I think what Artie was saying was perfect. Keep everything contained and simple, because the simpler the process, usually the easier to execute, and the easier to execute, the less stressful your trading life will be.
Right, and having that conviction as well means you can really put money into your trades. You can load the boat, and that's what we do. We load the boat with leverage whenever our high conviction trades come up, and you just can't do that when you're basically gambling, trying to time the bottom, catch the falling knife. You're not going to go in with size because you don't know what the hell you're doing. So even if you are right and you do catch the bottom, you don't even make much money. So what's the point?
That's a great point. And there's also something I want to bring up here, because in around the June, July area of this year, so roughly 3 to 4 months ago, there was a bunch of macro professionals, I want to call them, right, on Twitter. And they were basically emphasizing that this is a local low. We're near the definite lows. It's a great time to get long bonds for the Q4 recession. Some of you guys might know who I'm talking about, or the group I'm talking about. But long story short, this was where they were claiming, or the group, I should say, was claiming it's a great idea to get long bonds. Obviously, we didn't do such a stupid thing. There was no confirmation across any of our tools. And as Artie just said, we like to use leverage, right? So by using leverage, And doing this, you would have pretty much put yourself, and we're going to give the lows. We're going to say that you bought the low here of this range. You put yourself down 46% in 134 trading days, or 93 trading days, excuse me. You literally drew yourself down 50% for no reason.
The issue is in today's world, there are a lot of people, a lot of professionals out there, and people that are not professionals, people that don't know what the heck they're saying, and no one knows. The retail traders don't know who to listen to. Everyone flocks to someone that was right at one point and then hope that they're going to be right going forward. And so they make
Point.
a call and they listen to it, place a trade based on it. It doesn't work out. It's a loser. So how do you know who to listen to? It's like same with us. Why are you listening to us, the viewers right now? Why should you listen to us and not those other macro professionals that are on Twitter or they have their own podcasts? Why listen to us and not them? Quite frankly, I don't care if who you listen to, but us, we at least have a model that is concrete. We have set rules. The model doesn't fluctuate with emotions. It takes new data and updates itself and has new outputs based on new data that's coming in. It's fluid, just like the market is. Whereas all the other people, I don't know anyone else that does what we do. All the other people out there trying to time the bonds or time equities, whatever they do, there's a lot of emotion behind it. And they pick and choose data that fits their narrative. Whereas we have a model that doesn't pick and choose data. It uses the same data throughout history and it interprets that data and gives us an output. And
Right.
so
I think it's important, right?
that's why I feel like that's my selling point on why you listeners should listen to us over these other people. But at the end of the day, you do you, man.
Yeah, I think it's important though, because exactly what you're saying, right? Everything's dynamic in the market. There's nothing that's fixed, right? And a big part about what we're doing here is a higher level of transparency, right? So obviously, we're not going to give away the proprietary functions of our models. That's not what's going to happen here, right? Or that's not what we've been doing. But what we do give most people, or pretty much everyone that does want to follow us and does want to interact with us and basically gather more insight on what we're doing, we give access to pretty much everything down to a trading view indicator like you see here that you can use on your own screen, right? And while this isn't the economic model, it's pretty simple when it comes down to what's going on, right? Stocks were not a long after January 20th or so of 2022. That was it. That was it. It went bearish trend. Keep it simple, right? Bearish trends tend to lead to lower prices. Magically, they went lower, right? Magically, it was bearish trend. That's what should happen, right? Then the trend flips in February. Now, depending on obviously we double check our models. What happens next has to also line up with our models, but we have been saying pretty much since February, equities can bid higher. It's that we've been saying that. We said it can happen. The thing that we were also saying though is if the model doesn't flip, the regime and systems don't flip, then the bid will actually be very stretched. And we've been saying that if you go back on our podcast, we've been saying that the whole time. And sure enough, we're back pretty much on ES to where we were in April. And this is not magic. This is very easy to understand once you grasp the whole concept of what's going on. And what Artie was saying earlier, there's a lot of people that claimed this was the top or came out right over here saying equities are going down, right? And it could have just been something as simple as the market sold off aggressively and the Fed was hiking interest rates. Okay, time to sell. That's a general easy call, right? You can make that call with very little knowledge of a lot of moving parts in the macro space. You can just know those two factors and say, you know what, time to sell. And they got this move right. Now everyone's looking at them and saying, wow. I mean, we called this move in real time. If you go back on our Twitter page, right? We did this, right? So a lot of people did this too, and there's just a lot of prominent accounts that blew up in the process. Rightfully so. Listen, you got it right. But what ends up happening is they blow up on one move, right? And most of those shorted this market all the way up. And that's where the lethal part of this whole thing comes in, right? Because everyone's so fascinated with one major move. You need to be focused on the bigger picture, cycles over time, not 6 months, 8 months, a year, 5 years, 10 years, right? Whoever you're listening to, try and find a track record of what they're doing. Go the long term, get a broader view of how they've been assessing every situation, and understand why they are doing what they're doing. What's the reasoning? Is it emotion? Is it data? Because if it's data, are they analyzing that data with emotion? Meaning, are they cherry picking data here for this reason to be short equities here, but then the short equities here, that data has changed, so they got to cherry pick different data, and they end up actually just not getting anything right over the long term. So it's very important you guys break that down and focus on a solid concrete model and basically a process that is repeatable and also doesn't shake you out. Obviously, our models do use leverage, but they can be scaled to your liking or to however you see fit. If leverage is too aggressive, obviously do what best suits you. We're not financial advisors. You have to take your own portfolio in your own hands and make that judgment call. But at the end of the day, it's best to always take a step back and look at the bigger picture. But let's move back into the podcast now, and let's talk about what actually happened this week in the bond market, because a lot of people are very, very butthurt about this move lower. Some lost a lot of money. Some maybe are no longer in the arena, right? As I should say. But hopefully our listeners are still here and ready to strike when the time is right. But long story short, here we had real retail sales. That's retail sales adjusted for inflation, coming with the sixth consecutive print, rising towards zero. Okay. Now we're almost 75 basis points away, or 70 basis points away from positive territory. So real retail sales are almost near positive territory, meaning the consumer is, or retail sales, or the consumer sales are getting back towards that growth territory after accounting for the price increases from inflation. So that's something to watch. Now, Powell also spoke this week, and he outlined a few things. The first thing was that commercial real estate risk is really concentrated around smaller banks, right? And the reason he had to come out and say something like this is because the big question is the situation with rates, the long-term rates, obviously rising so rapidly. Commercial real estate loans have to get refinanced at some point. They may not be able to get refinanced at such current rates that are way higher than where they have been historically on average, and there may be some credit risks or emerging credit risks in the commercial real estate space. That's office buildings, et cetera, right? And he wanted to clarify that this is not 2008, right? The biggest banks out there don't have so much connection to these commercial real estate loans as they may have had in the past. So he wants to basically take out the GFC type of fear from the market, which he did. Now, he also did say that bank stress from SVB has settled and pretty much has calmed down, and they're still monitoring it for any type of hiccups. But the SVB crisis pretty much has been that premium in fear has been taken out of the market. And then he went on to saying that the labor market's gradually cooling with job openings cooling. That's JOLTS coming down, which is a good sign, right? And the reason that's a good sign is because you're basically restabilizing the labor market, and there's less of a disconnect, meaning there is going to be some reconnection in supply and demand, in the supply and demand metrics of the economy. Now, higher yields, right? He did explain that higher yields mean tighter financial conditions, and that these higher yields or these rising rates are not due to further hiking expectations. And this goes back to the compound landing, right? Stage three, and we're going to go over that shortly and what's been going on in the stage three arena in the compound landing framework. But long story short, the further hiking expectations is not driving long-term yields at the moment, and that's what Powell wanted to emphasize, because the terminal rate hasn't really changed, yet the long end keeps going up and up and up, and this has to do with stage three. So it's not really inflation driven, nor is it hike driven, because if it was inflation driven, the Fed would be hiking interest rates, right? So that you have to put those two together. And then Powell pretty much wrapped up the speech / conversation, right? Saying that the Fed policy is very blunt. And this is the problem with the soft landing. For those that are so gung-ho about the soft landing requires the Fed to basically thread a needle. And the Fed's already well aware, as everyone else should be, that their policy is very blunt. Okay, so the issue here is, will the Fed be able to pivot higher rates and restrict in a restrictive territory to a moderate restrictive territory / neutral territory quick enough with the economy rolling over at the same time to prevent some sort of drawn out or excessive recession, right? And I don't think that's possible. That's what stage 4 is really built off of, right? Stage 4, and which would wrap up the entire compound landing, goes from the beginning where the Fed is excessive and overstimulates to the end where the Fed is excessive and over restricts, right? And that wraps up the entire back end of a stagflationary / deflationary recessionary all in one cycle.
Right. So
Now,
I want to go from this to break evens. So we saw quite a move in the 5-year break evens this week. Now, obviously, this is just we've had these kind of moves before at the start of the year. So it depends on how sustained this move will be. But if it does remain sustained and kind of elevated at these levels, 2.5, 2.6, what does that mean for stage 3? Or even if it goes higher, if we start seeing it move up towards 3, what
right.
does that mean?
So, okay. So the reason why break evens are moving the way that they're moving is, if you notice, commodities have been moving a lot, have been moving more consistently, or I should say that commodities have been bullish a lot longer than these break evens have been ripping. Break evens here have pretty much been ripping only over the last week, right? And commodities have been pretty much holding on to bullish territory since the end of August. Now, why are break evens up? And the answer is, there's a number of factors, right? Number one is stage 3 is the main factor, obviously. And stage 3 is the effect of normalizing the economy, right? There's this idea that, okay, if there's no recession, I don't need to discount oil prices. I don't need to discount the yield curve. I don't need to worry about slower economic growth. All these types of things that are the reason for stage 3. Basically, stage 3 is the market saying, you know what, no recession, let's price in the soft landing 100%. So what ends up happening is you get the rebound in you're seeing growth GDP now at 4 to 5%. You have growth rebounding, right, in terms of energy prices, commodity prices. You have super tight labor market still. So obviously this is not out of fear of a recession, right? And what ends up happening is, as this continues, inflationary fears start to pick up. Well, if oil prices, if there is no recession, what's going to bring us all the way down sub 2% back into that average, that 2% average territory? Well, this is where the stage 3 kind of adds further restrictiveness to the economy, right? Because what ends up happening is yields continue to go higher, right? And that's something that Powell even said earlier this week, where higher yields mean further tighter financial conditions. And that's what stage 3 is. And higher real yields, all that does is emphasize the fact that there's obviously a rebound in the economy that's not being slowed just yet. And that's due to the lag in policy, which all shows up finally in stage 4 at the end. But until it does, seeing this move up here is not out of the ordinary. I'd say we listen. I've been commenting on this, but this chart has been all over Twitter for like months now, and I've been saying that this is the chokeout zone, right? Between 2.5 and 2, things are really nothing to worry about. Inflation remains well anchored. We closed Friday. This chart didn't update yet, but we closed Friday at 2.47. So we closed back below the 2.5 or the 2.5, excuse me, high here, which we outlined as the chokeout zone. So as long as we stay in between 2.5 and 2, I don't think we're going to have any sort of issue. But if this starts lifting out of the 2.5 range and starts basically solidifying a positive trend up here and starts grinding higher, I think we could see more rate hikes, because I think the Fed is concerned about future inflation expectations really revamping that inflationary wave. And obviously, Powell did mention again this week that the fight on inflation isn't over just yet. So I think we have to be careful of how this plays out. I do think that commodities in their current condition can trend higher. As long as the trend's bullish, oil can go up, commodities can go up. Ultimately, stage 4 will be the wrecking ball for commodities. But until stage 4 hits, stage 3 wave can ride on further. Now, We said this last week, but I want to reiterate what the stage 4 pivot would look like. Number one, gold would have to be a bullish trend. Gold has made such a move over the last week, up 5.99%. Gold bugs are cheering after getting stomped on since May of this year. They pretty much got obliterated. Now they're cheering back because they've got a lot of that drawdown has been returned. Now gold is back above Momo. Good thing, right? Okay, great. We are opening the door for possible bullish trend flips. The problem is, without that move in bonds and that crush in rates, and that crush in real yields overall, not break evens, real yields, the inflation adjusted treasury yield. Without the crush there and the crush in or the boost in bonds, right? The boost in bonds and the crush in rates, I don't think there's going to be enough juice here to really get gold moving. Not to say gold can't trend up and trend sideways, or even try and flip trend and hold this bullish trend like it has here. I just don't think we're going to get that juice to send this up to like $25, $26, $2,700 an ounce just yet. I think that's going to come with the full stage 4 pivot and bond trade. And obviously in that environment, US dollar goes up, bonds go up, gold goes up, and volatility tends to actually rise as well. If we take a look at the dollar is holding on to bullish trend. So the dollar is already kind of pointing towards a possibility of a stage 4 pivot, but it's still very early. Gold going would say, okay, yeah, we're getting close. But even gold and bonds, gold and dollars together don't have the same weight as bonds do.
Right.
Bonds are
we'll
very
have to
important.
we'll have to see the real yields reverse, and we're starting to see the 5-year real yields somewhat reverse a little bit more than the 10-year. But yeah, we're still really not seeing what we need to see for that deflationary pivot, which is stage 4.
And right. I agree with you there. I think that
I also want to add for those that don't know, when we do get our deflation trade, the way our portfolio allocates itself is split between bonds and gold. That's because gold moves with bonds. And so the time to get into gold is when bonds reverse and they head higher. So that's what you got to wait for. Look at bonds and it'll tell you what to do with gold.
Yeah, and here's a good example in the real yields, right? So we have the 5-year real yields. You can use 5s or 10s, whatever you want. They're still in a strong bullish trend. I mean, we'd have to get the 5-year real yield under 1.84 to really start getting concerned about, or that would be a concern that stage 3 is coming to an end, right? So you should always make these goalposts in your head, right? Always look at the situation and say, as these things progress, where am I within the cycle? Obviously, the compound landing is a recessionary fragment of our entire macroeconomic model, from risk on to expansion, inflation, stagflation, down to deflation, right? The compound landing emphasizes the latter part, or the end, I should say the end of that model, right? The beginning of the model is really just a booming economy. It's a bull market, right? Where pretty much anyone can make money. Long whatever you want, it usually goes up. Outside of, bonds or what, right? You want to long risk on assets. And I think that if you don't isolate that type of framework in your head, and you're just looking around and you're saying, oh, gold's going up, right? Gold's ripping. If the recession's here, the Fed's going to blow up, whatever you want. Whatever thing you need to spin to buy this, right? You might say, okay, if this goes bullish trend, it's done. Recession's here. What ends up happening is you don't have enough confirming factors on your side, and you end up offsides in a situation like this, right? Or even better, the Ukraine situation, right? We were adamantly calling this was a bullshit run. We were saying this is war premium. Don't believe this isn't the real gold move. And sure enough, we did good there, right? And we've been saying every bullish trend in this cycle, in this pre-stage 4 cycle, is not the long in gold. I want you guys to remember that. Wait for that pivot in the cycle to really get that fire going behind both gold and bonds. Gold and bonds paired together tend to hedge volatility in the portfolio. Gold will sometimes trend away from bonds, as it has been doing now, which if you were to 50-50 long gold and bonds back in 2022, when everyone was calling for a recession, your gold would have actually hedged out some of that bond loss. Maybe not by much, but it would have controlled some of that bond volatility to the downside. Obviously, we don't just blindly 50-50 long. This is no 60-40 model here. I'm just saying in a bull run, when both are going up, sometimes bonds experience higher volatility while gold is steady, and they both go in the same direction. So you can leverage both continuously and actually achieve lower risk off returns from a volatility perspective. So that's why we use bond and gold in our portfolio. But anyways, thank you guys so much for listening. We'll talk to you again next week. Keep your eyes peeled. I am assuming with ES on the lows, NQ next to a trend flip, things can get interesting here rather quickly.